You dream of early retirement, living comfortably on dividends? Stop before it's too late. Did you know giants like AT&T made investors lose everything? Analyzing the data reveals a critical trend. We see strong indicators of growth here. I'll expose the brutal truth of dividend investing and the precise formula to avoid this trap. Let's break down the math behind your dividend dream. It all boils down to a simple equation. Capital needed equals desired income divided by dividend yield. Imagine you want $50,000 a year in passive income. Now, check this out. That's a great goal. If you invest in a company like Apple, with its low dividend yield, don't forget the broader market picture. You'd need a staggering $12.5 million just to reach your goal. That's a huge sum, isn't it? Now, consider a different company, like Pepsi. They have a higher dividend yield, and that could mean a larger return for you. With Pepsi's higher yield, you'd need approximately $1.3 million. Structin Karat. That's a massive difference, purely based on dividend yield. But this is where the real danger begins. The allure of high yields can be a trap. Many fall for the siren song of exceptionally high dividend yields. But chasing these high yields often leads investors straight into a yield trap. These aren't sustainable, and they can destroy your portfolio. It's a huge red flag if a company's dividend yield is suspiciously high. Often, it indicates financial distress, or a company simply can't afford that payout. Don't be lured by the prospect of quick, high income. It's often a signal that a dividend cut is just around the corner. And these aren't just theoretical warnings. They're brutal realities.
Take 3M, a dividend aristocrat for decades. But times change.
Then, after years of consistent payouts, they slashed their dividend.
Millions of investors relying on that income were blindsided.
It was a harsh lesson in relying solely on past performance. Or consider AT&T, another dividend stalwart. They too dramatically reduced their payouts after years of consistency. This caused immense financial pain for countless retirees. It serves as a stark reminder to constantly reevaluate.
And Walgreens, a long-standing dividend payer, shocked the market.
They too cut their dividend after a long history. This highlights the importance of analyzing a company's underlying financials. Never simply rely on historical dividend payments alone. Fambers Traun. These real-world examples prove that high yields are not always your friend. Often, they're a symptom of underlying problems, not a sign of health. It's crucial to look beyond just the raw number. So, if high dividends are risky, what's the better approach? Let's shift our focus to a more holistic view of investment success.
We need to understand total return compared to dividends only.
Total return encompasses both capital gains and dividends, not just the income.
And often, total return strategies deliver superior long-term results.
Let's look at the data, specifically from Vanguard, a leader in investments. Their research consistently shows that strategies prioritizing overall growth consistently outperform those focusing on high dividends, often generate higher total returns than those focusing only on dividends.
This challenges the traditional dividend-centric approach for many investors.
Why does this happen? High dividends often mean a company isn't reinvesting.
They've essentially run out of high-growth opportunities for their capital. So, they return capital to shareholders instead of fueling future expansion. This directly impacts their ability to grow earnings and, consequently, stock price.
By focusing purely on dividends, you might miss out on capital appreciation.
The power of compounding through growth can far outweigh consistent dividend income. This is the opportunity cost, not letting your money work harder for you.
True wealth building often comes from growth, not just income streams. Companies with high, steady dividends are often mature businesses. They've reached a point where rapid expansion is less likely. While stable, their stock price appreciation may be limited. For long-term wealth building, growth often wins. It's about rebalancing your perspective on investment goals.
Is your primary goal wealth accumulation or immediate income? For most people, especially younger investors, accumulation should come first. So, what's a more balanced and effective strategy for dividend investing? This isn't about choosing one over the other. It's about timing.
Your investment strategy should evolve with your life stage and goals. There's a better, age-appropriate strategy for everyone. Let's dive into these specific approaches based on your age. If you're under 35, your priority should be growth. Leverage the power of compounding by focusing on companies with high growth potential. You have time on your side, so let that capital grow exponentially. Don't sacrifice potential gains for small, immediate dividends. If you're over 35, it's time to gradually shift your strategy. Start moving into dividend-focused ETFs like SCHD or VYM. These provide diversified income with more stability as you approach retirement. You're setting yourself up for a consistent income stream in your golden years. This balanced approach ensures both growth and future income stability. It's a methodical way to build a sustainable income stream. This allows you to enjoy retirement without fear of dividend cuts. But strategy isn't complete without considering the taxman. Understanding taxes is crucial to maximizing your dividend income. First, grasp the concept of qualified dividends for lower tax rates. These dividends are taxed at the more favorable capital gains rates. It's a key strategy to keep more of your hard-earned money. Next, unlock the power of a Roth IRA for tax-free dividends. Contributions are made with after-tax money, meaning withdrawals in retirement are completely tax-free. Imagine all your dividend income tax-free forever. This is an absolute game changer for long-term dividend investors. By combining these strategies, you maximize your dividend income. This is the path to truly living off dividends efficiently. Remember, the dream of dividend income is achievable with the right strategy. Your financial future depends on this knowledge. Don't wait. Empower yourself now.